It's Friday the 10th. This is what's going on. Japan wants its pension money back. SK Hynix raises lots of cash in America. And Andy Burnham looks certain, Lizzy, to be the UK's next Prime Minister.
Well, happy Friday, Guy. Here's how all of that's playing out in the markets this morning. The SK Hynix listing in the US lifting sentiment on the Kospi this morning, up nearly 4% as things stand. But the action in Japan really notable. As that money from the pension funds is being pulled back, or will be pulled back eventually to Japan, the yen lifted off multi-decade lows, and a boost for JGB yields, for JGBs as well. 277 down 10 basis points on the yield. The Nikkei lifted as well this morning. The countdown to the opening trade starts right now.
Friday morning, how are you doing? Let's talk about what's going on. Japan, absolutely firmly in focus. This was a press conference that nobody thought any news would really come out of with the Finance Minister, Katayama. It was a regular scheduled press conference, and then we get this bombshell pointing us towards the idea that what the government would like would be the large pension funds, and there are many in Japan, but there's one big one. Basically, the idea is that they would like these pension funds to reallocate domestically. Is this one of these moments, one of these huge moments, a bit like QT, where you just have to look at this and go, this could be a seismic shift in what happens in terms of global capital flows? Is it one of those moments? Because the largest pension fund, the government pension funds, runs $1.8 trillion worth of assets. If it starts moving, that's a supertanker. It will leave a big wake behind it.
Yeah, so just how much does the GPIF switch out of Treasuries and into JGBs? This morning you're seeing JGBs lifted at the long end of the curve, but not so much movement when it comes to Treasuries yet, because we need to see how...
This is the largest foreign holder of Treasuries there is.
Exactly. Treasuries make up just over half its foreign bonds. So let's see, when we know how this is going to happen, how far they're going to go with it, how much of a reaction we see in Treasuries. Basically, as the Bank of Japan's normalising policy, the Takaichi government wants to channel more domestic savings into a new phase of economic growth driven by AI. It's the stuff of dreams for the likes of the UK.
Yeah, we would like to see more domestic investment here. How would that work? What kind of flows will we see? Andy Burnham paying attention. We'll get to Andy Burnham in just a moment. But I think this kind of... I think this is a kind of QT story. It's maybe not of that scale, but it is of that kind of significance. For big investors, and you've got the GPIF, then you've got other funds that basically track the GPIF, so you're talking about huge amounts of money here. Other investment, you just kind of think about the concentric circles. Other investors are going to look at this and go, how do we invest? Do we follow the money? How do we hitch our wagon to this train? That's the kind of narrative potentially you're looking at here. But Japan has basically been the piggy bank to the world for decades. It has provided the capital to the world for decades. And capital is becoming an increasingly scarce resource that is becoming increasingly highly valued. And if the Japanese decide that they want theirs back, that is a big moment.
I've got a note here from Ben Eamons reacting to this morning at Highline Asset Management, calling it a good example of financial repression.
Yeah, it basically is. We are going to control it. We as a government are basically signalling, telling you what to do. Yeah. And QE, maybe I got that the wrong way around earlier, is another example of financial repression. This is government taking the market where it wants the market to go. Let's talk about SK Hynix as well, because this is a huge moment as well. It's raised $26.5 billion in the United States. The ADRs are going to come through later. We're going to be talking to the chair. Again, you need to take a step back and look at this story, because what you are basically looking at here is another example of a massive raise. SpaceX, one example of a massive raise recently. Then you get Google, Alphabet coming through, a massive raise. These are equity raises in the United States. Again, you come back to this idea that capital is becoming a scarce resource, and these big technology companies are consuming it in vast quantities at the moment. Previously, we've seen a market that's been shrinking. Now you're getting a market that is expanding in terms of the base of stocks that are available. That, again, is a seismic shift in what we're seeing in terms of the landscape that we've known for the last few years.
What we really need to see is who buys it today. Is it going to be retail investors? Is it going to be institutional investors?
Looks institutional.
Yeah, if you're trying to escape the volatility that we've seen in Korea, you would hope it's institutional, right? And I was just showing on Daybreak a chart from our Dan Curtis, actually showing that Micron has been more volatile than SK Hynix over the past month. So do you see that expectation of less volatility actually playing out when Hynix comes to the US?
It's interesting they didn't put a discount on this.
No, very confident, more than 3% above yesterday's closing price.
Precisely. So this is a really confident. We know we're going to get the money. We're confident we're going to be doing this. I think I saw Joe Weisenthal posting a picture yesterday. I think it was the JPMorgan headquarters lit up with the Korean flag yesterday.
Oh,
so Wall Street's all in on this trade. I'm assuming that picture is real. But I think it is fascinating that they're looking to tap this huge amount of desire within the United States to get access to this trade. And you wonder how it's going to be, again, deployed. Let's talk about burden on Burnham.
Yeah. Well, look, it looks like we have our next Prime Minister almost nailed on here in the UK. It's likely to be Andy Burnham because the nominations for Labour leader opened yesterday and there's no one else in this one-horse race. You had 322 out of 403 Labour MPs formally nominating him to be the party leader, which is just outstanding, given that we have no idea what this man really stands for.
This is amazing. This is basically a complete leap of faith by the Labour Party. That it has no idea what he wants to do. He's given us light indications as to what he thinks his policy path is going to be. Somebody described it as almost North Korean in the way that this process has unfolded. Yeah,
basically totally undemocratic. He's been elected by the people of Makerfield and he's going to become the Prime Minister. He's been out of Westminster for, a decade up in Manchester. And the likes of Theresa May pointing out, former Prime Minister, that it's very different running the country to running Manchester. But interesting, he had a piece in the Times newspaper on his foreign policy, basically saying that his focus is going to be domestic. There won't be a huge change from the Starmer regime. Let's see how he handles President Trump, because there's no running away from the fact that the foreign is domestic in this geopolitical situation.
I'm just reading the next story just with a little bit of interest because I'm trying to get my head around what is happening here. Apollo, not CastleLake, Apollo has reached a deal to buy EasyJet for £7.15 a share. Apollo is doing this. The proposed cash offer at EasyJet at $5.7 billion. It's a statement on possible offer. Holders would be entitled to get $7.15 a share. So this is a last minute kind of offer that's come through. CastleLake started this process, the private equity firm that specialises in these kinds of assets, sort of started this process, and it looks like Apollo, like a heavyweight in the sector to say the least, has basically come in with a higher offer and beaten the rival proposal from CastleLake. Huge surprise, I would argue, here. So the carrier, EasyJet, Kenton Jarvis, the CEO, saying Apollo's bid is superior and, quoted, is no longer minded to recommend the CastleLake proposal. This according to a statement from EasyJet.
Yeah, 6% higher than the last offer of $6.50 per share. They've got until August 3rd, right?
I think that's the put up and shut up dates that got pushed back.
Maybe we'll see some more.
But now I think it becomes interesting. How does CastleLake react to this?
Yeah.
Is this a bidding war? This is what I would have thought EasyJet would have wanted, a bidding war for the assets. Which, it's going to... how much further does this process run? But that is a big surprise. We'll try and get some analysis on this and come back to you with some news that we can bring you here at Bloomberg on that story. OK, what else have we got coming up on the show? David Forgash, PIMCO's head of leverage finance, is going to be joining us. Lots to talk about with him. Sophie Wynn, BNP Paribas asset management portfolio manager and dynamic asset allocation strategist. Heck of a title. And Carlos Carenza, M&G Senior EM Debt Fund Manager, and critically this morning, after the France win, co-author of the firm's World Cup prediction model, which I have to say, having looked at the numbers this morning, is doing quite well. Yeah, well, we'll be able to tell you who's going to win the World Cup later on in the programme, perhaps. But let's look ahead to what else we're watching throughout the day. Today, we have EU finance ministers gathering in Brussels. We also, as we've been mentioning, have SK Hynix's Wall Street debut. At 9 a.m, we have the IEA oil market report, of course, very much in focus given the geopolitical background. And then later on, Delta earnings reporting before the US market open. OK. There's quite an interesting story developing around this debt story, that Spain pushing quite hard to get joint debt. Now, this is a reasonably common theme, and a lot of people have basically said, yes, if you're a peripheral country with lots of debt, you are going to be pushing this idea. The Germans increasingly, obviously, have pushed back on this story. Nevertheless, it is kind of one of those stories that it feels like it is slowly gaining traction. I don't know how it's going to evolve and how long it'll take, but it does feel as if you are going to compete with the US Treasury market, you need to have increasing amounts of joint debt in Europe. So how long can Germany hold the line on this one? Even Christine Lagarde is kind of talking about proposals and understands why this would be something that would be of benefit to Europe. But obviously, we have a joint currency but different debts, and that remains a key kind of architectural glitch that we have in terms of the way that we run money in Europe.
Yeah, anyone at the European level saying it's pretty obvious, Lagarde or Kyriakos Pyrekakis saying that this is a good idea, but when you get to the national level, a lot more scepticism, a lot more caution. Well, Bloomberg's Oliver Crook will be speaking to the Spanish Minister for Economy and Trade, Carlo Cuerpo, later on this morning on this subject and others, so don't miss that exclusive conversation at 9:30 a.m. London time.
Coming up, we're going to look at your stocks to watch. What have we got at the open, including Volkswagen? We've got the German automaker looking to cut its model lineup by up to 50%. Please don't cut the Golf as part of a cost-cutting drive. Plus, Mark Zuckerberg speaking exclusively to Bloomberg about Meta's plans to develop cloud businesses and read out AI infrastructure. More on that interview. Up next, we're going to be joined by Zoe Gillespie, Senior Director at RBC Bruin Dolphin. We'll get her take on what is happening with this Japan story, plus all the other asset allocation decisions that she's talking about right now. You want to join in the conversation? And we'd love to hear from you folks. IB plus BB TV Go is the function. This is Bloomberg.
Well, we are 45 minutes away from the opening trade. Here's what the futures picture looks like. Not really following the optimism that we saw in the Asian session. The MSCI Asia Pacific Index up 1.2% on the enthusiasm around tech. But here in Europe, we're down 0.1%. And S&P E-minis and Nasdaq futures both in the red as we head towards the Wall Street Open as well, Guy.
OK, let's talk about what's been going on in Asia. There's the tech story, but there's also the Japan story. Japanese bonds and the yen rebounding from multi-year lows. This after the finance minister called for Japanese pension funds to invest more in domestic assets. This a little bit of a surprise. Bloomberg senior editor Brian Fowler in Tokyo with this story. Is this a surprise? Where did this come from? How big a deal could this be?
Yeah, you've asked just the right questions we've been trying to answer. So the context is important. This was at a regular press conference following a cabinet meeting in which she talked about lots of topics, including BOJ independence. And then she was asked a question about the growth strategy that was announced a week ago that plans trillions of dollars of investment in 17 sectors over the next 14 years. And the question was, how does this plan benefit ordinary people? And her response was, well, we really hope that pension funds, as well as individuals, will invest more in domestic assets. And that's basically what she said. So it's kind of hard to know, for example, how serious this is. On the other hand, it comes against the backdrop of Japan having persistent inflation at 2% for the first time in a very long time. And I think there's a very real sense in the government that Japanese individuals need to be more invested in domestic assets if they want to stay ahead of inflation.
And how easy is it going to be to get Japanese pension funds to comply, especially when you've got one massive one, the Government Pension Investment Fund, one of the world's biggest? Is it likely that it would do what the finance minister would like it to do?
So the first thing, the finance ministry does not oversee the GPIF. It's overseen by the health and labor ministry. So that's one thing. And then the GPIF sets its allocations every 5 years. And the latest round of that was in March of last year when it kept its allocations at 25% each for domestic stocks, domestic bonds, overseas stocks, overseas bonds. There's some wiggle room, of course, in case asset values for one of those components rise versus the others. But as of March this year, it was the GPIF was keeping very much right at those allocations. It was just almost 25% even across the board. So there's a process. Now, having said that, could Takaichi sort of give the ministry a little hint, a little nudge saying, we'd really like to see those asset allocations tweaked a bit? She could definitely do that, and who knows, maybe the ministry would respond to that. We're still trying to kind of get a sense of how independent the GPIF is. So there's no real way to answer that for sure, but if they do respond, it would definitely be a big boost to the yen as well as bonds.
Absolutely. Kind of even small tweaks here could have a big ripple effect. And it's interesting to see the PPI number coming through as hot as it did a little earlier on as well today. Brian, great stuff. Thanks for catching up with us and look forward to the further coverage on this. Bloomberg Senior Editor Brian Fowler joining us out of Tokyo. Let's bring in Zoe Gillespie, Senior Director at RBC Brewin Dolphin. Good morning.
Good morning.
You've got an underweight. Let's just talk about this story for a moment. You've got an underweight on Japan. Would something like this make you go back and go, let's have another look at that? We don't want to change things quickly, but let's just have new information. Let's re-examine.
Of course, you would have to revisit it because you would have to look at your case. And I think when we've looked at Japan, we've been, it's obviously had a run because of, again, the AI trade. The tech names have done very well there. But structurally, you're looking at increased inflation, whether borrowing costs are going to come through. So I think there's other factors, but you're right. I mean, if it's going to be supportive of equities, then that might change your stance on having, as you say, look at it again and see if we do change our opinion on it.
How difficult is it at the moment to kind of make big calls? You've got a tech trade that is looking extended, maybe late cycle, but still has the potential to go a lot higher from here. You've got a narrative around what is happening with inflation. How easy are the calls you're making at the moment? Because it feels like tectonic plates are beginning to move under a market that's got used to being stable for quite some time.
I think it's really difficult, as you say, to make decisions. And I think this week as well, with what's happened in the Middle East, it's thrown another, factor into it. We're coming into earnings season, and I think that's going to be key for us to make any real changes because we're looking at companies, and we had the last, certainly earnings season that companies had reported a bit of increase in earnings, which was, again, supportive for equities. But you're looking for any, I think, hints and changes in consumer patterns, you see, with inflation coming through. The AI names, are they going to deliver? And we have seen a real shift this year. So making decisions about portfolios has become increasingly tricky, and it seems to be every couple of days the news changes, and it moves the dial quite considerably.
Yeah, are we in a bubble when it comes to earnings expectations?
I think there's a lot of pressure on it, but I think it depends what sectors you look at. I think with tech, yes, but there's other sectors where valuations don't look that compelling. So if we do see some upside or as you say, decent earning growth coming through, then we may see a bit of a pop in some of the share prices. So I think it really is. But you're right. I think the expectations are high coming into Q2 earnings, and it's whether we do see the same numbers that we got through in Q1, and I think that's going to determine a lot about how we position portfolios going into the second half of this year.
Well, you like European stocks, but not the UK.
Yeah.
Is that a hedge against the AI trade?
Yeah, I think certainly we see there's more value in Europe just now, and I think when you look at some of the sectors we've liked this year, European banks have done really well. I think the industrial names have done well, so we've picked up these, and as you say, it is a trade against the AI. And certainly with the UK, it's more defensive names, and you've got your energy stocks, healthcare there. So it is the trade-off trying to have that diversification within portfolios just to make sure that you're not just having that big AI bet, and if something does happen there, which we have seen volatility, that it has more of an impact on portfolios.
You're overweight cash.
Yeah.
Is that because you think something's about to happen? You think there's an opportunity coming? Presumably it is. Or is it just it's a safe asset that is yielding fairly decent amounts at the moment, and actually from a risk-reward point of view makes sense?
Yeah, I think a bit both. I think we've sat on the sidelines, and I think when markets have got a bit ahead of themselves, we've maybe taken a bit off the table to try and deploy at other times. But yeah, you're right. I think it's given good returns, and it is a safer asset just to hold just now.
Why do you like gilts?
Well, interestingly, we're underweight bonds, but we like gilts. And I think going into, you're certainly within the bond space, with inflation, you're looking at potentially yields going up. But within the UK, we think there's potentially less, scope for further rate hikes from here.
Yeah.
Again, the political pressure, obviously, you've got the change of Prime Minister, and I think there's been a lot of talk about whether there's going to be a more left-leaning government. But if you look at it and you think, well, Burnham has agreed to stick to the fiscal rules. He's said that he's not going to change significantly from the mandate. So we think that's supportive for gilts from this point onwards, and we favour that more than other bonds. But we are underweight bonds, but we do prefer gilts in that space.
Just back to the UK asset story. Why are UK equities underweight? I look at the story this morning. EasyJet, a massive bid coming through this morning from Apollo. You got a bidding war for another UK asset that's potentially going to be taken out. People are buying UK assets privately because they think they're cheap. Why can't the markets value UK assets at a higher level when private is prepared to come in and make kind of significant premiums?
And we have seen that across the board, but for some reason valuations still seem to be depressed in the UK, and it seems to be the unloved market. And I don't know whether it is the lack of tech names and the excitement of other things, but
precisely. But if everything else is overloved and the UK is underloved, isn't the UK the hedge against the overloved stuff?
It has been, and we saw that in 2022 when certainly that happened. But it doesn't seem to be that money has been going back into the UK. And you're right, we have seen international companies coming in and taking out some of our assets instead of, as you say, shareholders actually starting to benefit.
Zoe, thanks for coming in to see us. Zoe Gillespie there, Senior Director at RBC Brewin Dolphin. Guy.
OK, what else do you need to know this Friday morning? A US official has told Bloomberg that technical talks are continuing between the US and Iran, despite a flare-up in hostilities this week. The comments are likely to ease fears of a return to all-out war after the US launched fresh strikes on Iranian targets. Washington said these strikes were in retaliation for what it says were attacks by Tehran on ships in the Strait of Hormuz. To Germany, and Volkswagen plans to cut its model lineup by as much as 50% as part of a shake-up at Germany's largest car maker. The savings push was announced after a closely watched supervisory board meeting that stopped short of agreeing on deeper job cuts championed by CEO Oliver Blume. Volkswagen is facing its most significant restructuring in decades as it contends with slumping profits in China and weak demand in Europe. And AI teams at JPMorgan have delivered some promising results as they seek to latch on to the boom in automated trading. Researchers at the bank built an array of AI-powered investing agents that shift between stocks and bonds depending on the changing market conditions. In back tests spanning the past 2 decades, the best-performing system topped a traditional 60-40 portfolio by 0.7% a year. Now, that doesn't sound like much, but if you compound it, I guess it probably is. But that was the best one.
Yeah.
Outperforming a 60-40.
And we have to say that it's not based on live investing, it's based on historical simulations, so an important caveat.
No, but you backtest this stuff.
Yeah.
Like 2 decades of backtesting over the data sets that they have probably gives you a pretty accurate idea of whether it would have performed or not.
Yeah. Well, let's see. It's taken 2 years to get to this point, basically, so it's only going to get better, surely.
Presumably it will get better, yes, but... And 0.7 is not an insignificant number in terms of overall outperformance. Again, if you compound that number.
But also, if everyone's at it, all using AI,
precisely.
Then we all think the same way.
And it cancels the advantage out within a market that is increasingly driven by this kind of process. OK, but another example maybe of how the finance world is going to change.
Well, coming up on the programme, a hot credit market presents an opportunity for junk-rated firms. We'll discuss with PIMCO's David Forgash next. Stay with us, this is Bloomberg.
OK, here we go. 30 minutes to go until equity markets open here in Europe. It's Friday morning. It's a weekend coming up with lots of sport and lots of things to talk about. There's some nice tennis taking place as well today. Keep an eye on centre court. In terms of the futures picture, like relative to what we've seen out in Asia, but this is kind of the daily theme, we are seeing a relatively becalmed market. Certainly not as whippy as we've seen Lizzy Burnham out in Asia overnight. The Cosby having another dramatic session.
Yeah, I mean, some pretty pronounced moves in Asia when it comes to the long end of the Japanese bond curve, given all that we've been discussing when it's in terms of what the finance ministry's been saying about pension funds bringing assets home, and those moves on the 10-year down 10 basis points at 277, not quite translating here to Europe, but we are seeing yields lower at the start of the trade. The 10-year bund yield down 2 basis points at just over 3%. Well, junk-rated companies are seizing on credit markets flushed with cash to secure better terms from lenders. Bloomberg data shows that loan repricing volume in Europe hit over $43 billion in June, the single highest monthly total since 1999. The repricing is not popular with Wall Street, who must either decide whether to find a new home for their money or stay invested with lower returns. To discuss, we're joined now, I'm pleased to say, by David Forgash, who is Head of Leverage Finance at PIMCO. Great to have you with us in London.
Thank you.
Basically, we're reporting that there's so much cash in the loan market that even weaker borrowers are repricing debt more cheaply. I wonder how much that situation could change given the situation in the Middle East if we actually have all-out war. Trump saying that's not the possibility right now, but, you know, if we end up with an inflation problem again and higher rates again.
Yeah, well, it certainly makes it more difficult, especially for leveraged loan borrowers to refinance. And that has been a big concern, which is why you've seen so many of them trying to come in during this period of no hostilities or less hostilities, trying to come in and do these refinancings, these extended amends, anything to push out the maturity schedule. Now, if you do see this continue and you do see rates increase, that's obviously a direct effect on those borrowers that have floating rate exposure. And that is the leveraged loan market.
And you say that there's this growing divide then between high yield bonds and direct lending. Why do you think high yields become the safer part?
Well, high yield has become safer, and it's witnessed by just looking at ratings. High yield now is much more double B, so the higher credit rating within high yield than it ever has been in the past. It's almost 60%. Double B in the U.S. and in Europe, it's even higher. It's about 67%. So it's much higher quality. The duration is much lower in high yield. It's the lowest it's ever been. It's about 3 years. So, and the refinancings that have taken place in high yield have taken the maturity schedule, the wall that we call it from time to time, out to about 2029. So very little in 27, almost nothing in this year, and then it pushes out towards 28 and 29. So they've done a very good job. It's a much safer market than it's been over the past several years.
Is capital becoming a scarcer resource?
Capital's there. Capital's there for the right deals. It's the demand for that capital that has increased through AI infrastructure. There's much more of a demand for this. That ecosystem of AI, whether it's from the data centers, the chip manufacturers, whether it's investment grade, high yield, it has increased quite a bit. So it's not a crowding out as of yet, but there is more options to invest in if you're a high yield or leveraged loan investor, which for us is fantastic. It gives us an opportunity set that wasn't there prior.
What does that mean in terms of yields?
Well, generally, when you have more demand for the same product, you're going to have. It's so far that demand has not been made having to have much higher yields. The spreads have moved wider. So now spreads have moved wider. One of them was a downgrade we saw yesterday in an investment grade issuer. But it's more the ecosystem now is controlling and realizing that if you're going to have this much of a demand for capital, that clearly you have to make sure there's a profit towards the end of it, so you start to have some doubts about that. And then spreads start to widen for that reason. I think that's just what we saw over this past week, which was actually quite healthy for the market, getting paid more for that risk and the need for more capital.
OK, but on the negative side, that's the opportunity. You say that you don't think you need a recession to see stress emerging. If growth stays reasonably solid, where do you expect the cracks to actually show up?
Yeah, so the idea of stress in the market, it's less of stress, more of dispersion, because there isn't a lot of stress in the market so far, and it's less of a macro story. It's more of a capital structure story. So capital structure within each of these credits, which means that capital selection or credit selection, single name credit selection, becomes more and more important. So you have these large capital structures that have borrowed oftentimes during 2020, 21, when rates were very low, and the debt to EV, the multiples that we use, the EV/EBITDA, had been very stretched. Low borrowing costs, very stretched. Those capital structures are unsustainable many times.
When do those vintages break down?
They break down when there's a refinancing.
When does that happen?
That happens this year and next year for many of the leveraged loan borrowers, and that's why the anticipation is.
Is that a pricing problem or a recovery problem?
That is a recovery problem, because that becomes, at that point, the pricing of it is already coming into effect. Pricing goes lower because the concerns about refinancing and recovery and liability management exercises, which we should see pick up. But that is very much in, say, the software area of leveraged loans and definitely the private direct lending market.
So how different would it be to previous credit downturns?
Previous credit downturns are usually based upon the economy, a recession, fears of recession. That's less so right now. We haven't hit that point of being concerned. Growth is still quite strong in the U.S. It's not as strong here in Europe. So it's less of a story about a recession causing it. It's more of a story about capital structures that cannot maintain going forward because there's less ability to refinance those.
Coming back to this issue of crowding out, what did you make of the Oracle downgrade?
So anytime you have a downgrade, it resets the whole ecosystem, right? So it's less about a single downgrade, and it's more about the circularity of the AI industry, right? Because you've got these data centers, and you've got the demand side, the offtake, you've got everything that goes into the data centers, you've got the chips that need to be financed, you've got the energy infrastructure that needs to be financed. All of that, when you take it as a whole, the natural way to look at it would be that there's more stress in it and more doubt about how the long-term earnings are going to end up for that. Because in the beginning, it's very optimistic that these will end up having earnings that will offset that capital that you're using. So when you have a downgrade like this, I think it brings people's minds into the idea that you've got more risk in that, and you need to get paid more for that, which I think is quite healthy.
When you look at that, how are you thinking about, what metrics are you using to assess the pace at which the investment into data centers is going to pay off? Because the longer it is, presumably, the bigger the problem we have. What are you looking at? Are you looking at the real economy, trying to figure out kind of whether companies are getting productivity benefits? Where are you looking to try and judge that cadence within that story?
Yeah, and I think that's the trouble that the market is coming to the realization of right now, is how far out are those earnings and how large will they be? And if you bring those back, will they offset all the infrastructure that's being built into it, right? So it's a single name underwriting that you need to do, whether it's the data centers, the idea of what the contracts are and how strong those are, how quickly those data centers could be built, whether the infrastructure will be in place because you need to energize them, so you need to have the energy into them, and how good those contracts are for them. Now, in the end, there is some guesswork for a lot of the economy as far as what that end result will be. Now, we take a look at it and we see what we can actually see as far as looking forward on the earnings that is the expectation based upon each individual company. And we have a lot of analysis that goes into that. And I think we do a very good job of it. But in the end, the market is repricing the concerns about how do you, in the end, recognize whether that will pay off. And I think what the market's telling you right now is we need more information on that.
Okay, David. The big question remains. David Forgash, Head of Leveraged Finance at PIMCO, thank you very much for stopping by to see us while you're in town. Well, EU policymakers, meanwhile, are calling on Europe to take AI more seriously.
Artificial intelligence is the technology that will shape competitiveness and economic power in the 21st century. Europe must create the right conditions, mobilize the necessary capital, and enable its companies to achieve the scale to compete globally so that the next generation of global AI champions is born, grows, and remains here in Europe.
Kyriakos Piriakakis, the Eurogroup president, of course, speaking at a gathering of EU finance ministers in Brussels. We'll have more on the AI story next. This is Bloomberg.
the key word right now is rotation. So literally everybody knows tech stocks are crowded. What you don't want is you sell tech, but you also sell everything else. That higher correlation environment at either a single stock or a sector level, that's where you get these dangerous turns in markets.
Three things that are really going on. The first is exactly the part you talk about, and that's the macro side. So that is oil prices, which of course is driven by nervousness about the Middle East. Second, you've got the fundamentals, which is the earnings and the earnings power and what that might look like. And then on the third, you've got the crowdedness of positions. At the moment, it all depends on what the day before looked like.
You have Kospi Vol trading above 80 for extended period of time. That's 3 times more than, say, Hong Kong, for example, and 5 times more than the VIX, right? So if you're going to have your biggest, most high conviction positions in an 87 vol index, you will have to reduce the size of the index, size of your position.
What you're seeing in Korea in particular is that there's still that kind of dip buying within retail. Yes, you may have had some profit taking post Samsung results, but until I think you see persistent weakness over multiple days, multiple weeks, I wouldn't really call it a bear market.
It's going through sentiment cycles, and I think that's a bit what we're dealing with. I mean, the dispersion is just shocking, what you see between some of the Mag 7 even. In the very near term, I would not be surprised if the Mag 7 or the hyperscalers will trade a bit better, and if the semiconductors continue to be quite volatile.
Quite volatile. Yeah, let's pick up on that thought. Some of our guests talking about what we're seeing in terms of the tech story, the earnings story, the rotation story that we continue to watch makes your head spin. Let's stick with the semi side of things, because talking of kind of head-spinning numbers, let's talk about SK Hynix, set to list today on the Nasdaq after raising $26.5 billion in its ADR offering. Got priced yesterday. Just taken down with just extraordinary appetite, 7 times oversubscribed. The South Korean chip maker's US debut now tops Alibaba to become the 3rd biggest listing in history and the largest in the United States by a foreign company. Big numbers, head-spinning numbers. Let's talk to Bloomberg senior strategist Neil Campling. Neil, another company, another big kind of AI-related tech company raising gargantuan quantities of money in the United States. SpaceX is one that instantly springs to mind. You've got Google doing the same thing. Now you've got SK Hynix coming to the market and raising huge amounts of money. What does this tell us about the state of where we are right now and the demand there is for this stuff and how this kind of ultimately plays out?
Yeah, I mean, it's a great question, because there is huge amount of appetite for this deal, as you mentioned. And actually, as you've said on the intro there, talking about momentum and dispersion and tech positioning and crowded trades, and that they are all very true. And this goes more to that point that there's still huge, tremendous appetite for these transactions. And actually, in conversations I've had with clients, there's more interest, I would say, in this Hynix deal from institutional funds than there was maybe even for the SpaceX deal. So there is great appetite for this. There's huge amount, obviously, they're raising that's going to be put to work themselves into capex, and there is other trades around whether this could potentially have some index inclusions, whether there's passive fund involvement as well. But of course, as you mentioned, volatility as well in this particular sector is likely to continue, because there's going to be more leveraged ETFs around this new instrument that's coming to the market. So volatility in this part of the tech space in chips is unlikely to stop anytime soon.
OK, so we'll watch how the listing goes down. You mentioned SpaceX, Neil. SpaceX, of course, rented access to its Memphis data center to Anthropic. It feels like maybe Meta wants to do something similar. We had this exclusive interview with Mark Zuckerberg talking about considering whether some of its AI infrastructure would be more valuable if it were rented to outsiders. Is that not spin? Is it not a bad look when you've got spare capacity like this?
It's an interesting conundrum, because Meta have been very clear that they need all of the compute power for internal purposes. But the suggestion was they had such high demand at such high prices that they see a great opportunity for them basically to turn really their energy into tokens and sell. I think the other plan is to sell access to intelligence, much like Alphabet has done as well. So Meta's been early in collecting energy, in building data centers, and the vision that they have. They're also, I think this is telling you that by monetizing these strategies, in selling compute power, they are not done by any means in terms of their own investment phase. To add into what we were discussing earlier, and with Hynix's raise as well, I suspect you're going to see the capex estimates of Meta to move higher as well, and they could also look to do what potentially in time what Alphabet has done recently in terms of coming back and tapping the markets for more capital. So requirements go up in terms of compute power, demand is going up, and now we're seeing this step forward. I think that Meta is looking to compete directly against frontier AI labs. Whether it's successful obviously remains to be seen. Execution's a key risk for them, clearly.
OK, Neil, thank you very much. That's Bloomberg's Neil Campling. And Bloomberg's Ed Ludlow will be speaking with the SK Group chairman at 3:30 p.m. London time.
Looking forward to that interview. Definitely tune into that. The Japanese want their pension money back. Our executive editor for Asia Markets, Paul Dobson, joins us now. Paul, how significant could this be?
Yeah, good morning, Guy. Financial repression appears to be alive and well and living in Japan, with the comments that we heard from Finance Minister Katayama today talking about wanting the pension funds to invest more of their money in Japanese assets. Our reporting uncovered that this was a sort of pre-planned statement that she gave at a regular press conference. And the idea being that it's not certain whether this is jawboning or if this is definitely a start of a new policy and a new plan among the Japanese government to get more of those investments that are overseas to come back home. The effect of that, of course, would be to put a bit of a cap on Japanese government bond yields, which would be very handy for the government and also support the yen, also favourable for the government given the pressure that the yen has been under. Best way to do it, have higher yields, make your Japanese government bonds more attractive, but they don't really want to do that. So we'll see. It will take a while for pension funds to actually change their mandate. We'll see whether this starts the ball rolling for some initiative that could really change things.
But Paul, what could it mean for treasuries if you have a switch out of them and into JGBs?
Yeah, so one more reason to be a little bit more worried, particularly about the long end of the US yield curve. Japanese investors hold a significant amount of treasuries, a significant amount of European government bonds as well, for that matter. And were they to reduce their holdings overseas in order to put more into Japanese government bonds, that would, of course, cause a rebalancing effect. And it might set a precedent for other nations to follow as well. So it might be a sort of knock-on effect. I think the bigger concern here is exactly who is buying all of those US treasuries at the moment. The ownership has changed quite a lot. We know that hedge funds own a lot more. Part of the basis trade by shorting the futures and arbitraging the gap between them. That makes them much more volatile and susceptible to kind of flight in times of risk. So it's not great for the US government. They would prefer long, stable pots of cash investing in US treasuries.
Yeah. I think everybody would like that. That would be very nice. Paul, we're going into a weekend. The US markets will close. Are we going to get more Gulf-related action at that point? Is that the risk that we worry about going into this weekend?
Well, so the trading pattern that we had, remember we had a conversation like this during the war, that weekends were the worst time of the week for traders because they weren't able to, change their positions if there was any kind of flare up in the tension. So people would get very nervous on a Friday and be closing down their positions as much as possible, so there wasn't that much risk at the weekends. I think we're in a different environment right now. The market is still relatively calm, despite the flare-up that we saw in the tensions over recent days, and the reaction in the crude oil price even wasn't that extreme. So maybe not the same as we were before, but people will still be watching their mobile phones for news.
Paul Dobson, Bloomberg's executive editor for Asia Markets. Thank you very much. Have a great weekend. Well, let's get to the stocks to watch now with Chloe Melly. And Chloe, you're looking at EasyJet.
Absolutely. Good morning, Lizzy. The EasyJet saga is back on, and now we have got a takeover battle on our hands. So EasyJet has just received this morning a rival offer from the private equity firm Apollo, which is actually superior to the bid from CastleLake. So we have seen the shares go on a really wild ride over the last month or so as CastleLake kept upping its offer to try and bring EasyJet to the table. The fifth takeover bid was a successful one, but now we've got this surprise twist, this new player coming into the game, and so we will be be seeing probably a huge market reaction this morning. This is really going to be the story to watch. So EasyJet definitely on our minds this morning. We also have Volkswagen to think about because the company is planning to cut its product lineup by as much as 50%. This is part of a broader restructuring plan for that car maker. The CEO wants to cut lots of jobs and close down a few manufacturing sites as well. It's because he said that this business model of making cars in Germany destined for export is just not viable anymore. This will have consequences as well for that broader European car making sector, with Bloomberg Intelligence saying that we could see a prolonged run of profit warnings until we get that EU policy reset, a stronger policy support. And finally, staying in Germany but going to the banking sector with KBW upgrading Deutsche Bank to a market perform rating. This is a company that's been really benefiting from its trading business, but then also has the challenges of the private credit exposure and the slowing loan growth in Germany as well. And so we have seen the company underperform, as we can see here on the graph, the broader European banking index. But maybe this vote of confidence from KBW will lift the shares this morning. So also keep an eye on Deutsche Bank at the open.
Great stuff, Chloe. Thank you very much indeed, Chloe Melly, on the single stocks we need to watch out for. So EasyJet closed at 588. The CastleLake offers at 590. The Apollo offers now at 715. I've seen 5 to 10% on the upside for EasyJet this morning. Apollo's got a few questions it needs to answer here, one of which is how does it get round the ownership rules relating to Europe? I haven't seen any information on that yet.
Surely there's a risk of overpaying if they get into a bidding war here.
This was a very depressed asset, but yeah, that is the risk.
Yeah,
but we are now into a bidding war.
Yeah, and we've got high jet fuel. Who would want an airline right now? Right, the opening trade coming up next. This is Bloomberg.
Morning, how you doing? A couple of minutes to go until we start trading here in Europe. Let's talk about this. This was a chart from yesterday, and basically what it's telling you is we've got a little on the upside to price in to the European picture. We went out there, finished a little bit higher, but there's still some upside maybe to focus on. So let me show you the futures picture, give you an idea of what we're looking at there. You've got a lot to fold in this morning, haven't you? You've got the whole Japan story, you've got what's happening with the tech story, plus you've got the gold story, all of that to fold into the narrative. Eurostoxx 50 futures, a little negative, but only down by 1/10%. Elsewhere, you're getting some positivity returning to the FTSE 100, which got hit hard yesterday by AstraZeneca. DAX futures, absolutely flat. So it looks like we're going to see a little bit of calmness into the Friday session, but there's still obviously a weekend to come, and we're going to be watching very carefully what happens in the Gulf as a result, Lizzy.
Perhaps not calmness, though, for EasyJet, Guy. It's indicated higher by double digits on TradeGate after that fresh offer from Apollo. Of course, that beats a rival proposal from CastleLake, so we're all in the mix now. We'll keep an eye on EasyJet. Also watching Volkswagen. They had this showdown at the supervisory board meeting yesterday. The CEO pushing for job cuts, didn't get them, but they are looking to halve their model lineup after the impasse. So TradeGate not suggesting much of a move, but we'll keep an eye on them. And then also in Germany, Deutsche Bank upgraded to market perform at KBW. Do we see outperformance for the individual shares this morning on the DAX, Guy?
OK, here we go. Let's talk about the market open. Let's give you an idea of what the numbers are actually going to tell us. We think it's going to be relatively quiet. Look below the surface, though. There could be some really interesting narratives beginning to develop. The airline sector, I think, is going to be fascinating today. We'll see exactly what happens with this extra Apollo bid coming into the market for EasyJet. But keep an eye on the oil story as well. Anyway, let me show you some numbers, give you an idea of what is going on. This is the picture. We're anticipating a fairly flattish start for the FTSE 100, maybe a little bit of upside. Got battered yesterday by Astra. We'll come back to that, I think, over the next few days. The FTSE it's expected to be 0.02% higher. Elsewhere, I think you're going to see not a lot of activity. The Stock 600, absolutely nothing to see here. Europe feels again, after the volatility of the Asian session, like a sort of area of calm. Does that signal something about it as a diversifier, it as an area of reduced volatility, a place to hide maybe from some of this volatility we're seeing both up and down, obviously, with the story surrounding tech? So here we go. fuller picture. Stock 600, nothing to see here. FTSE's up a little bit more. CAC's doing nothing. AEX is down by 0.4%. We'll dig into the details of why in just a moment. The IBEX has got nothing to show for itself this morning. The DAX is a non-starter yet. We'll come back to that market in a moment, and we'll look deeper into the FTSE 250 for some of the stocks that are moving there, particularly in the airline sector. Lizzy Burnham.
Well, let's take a look at the sectoral breakdown. You've got about 3/4 in positive territory this morning. At the top of the basket, basic resources up 1.3%. Autos up 0.6%. And I'm just checking in on Volkswagen. Those shares actually up 0.9%. As I say, they didn't get to a decision on job cuts at that supervisory meeting yesterday. But at the bottom of the basket, energy, you'd flagged that guy. If you look at the oil price this morning, Brent is weaker by 0.2%. It's been in flux throughout the session, but $76 a barrel is where we trade. We have reported that the US side, at least, in the US-Iran talks, wants to keep talking despite the strikes both ways. And then we're also keeping an eye on airline and EasyJet in particular. So where are we for that? Not trading yet. So we'll wait for that. But other sectors moving. Tech, bottom of the basket, down 1.1%. So not following on from that enthusiasm that we'd seen for the AI trade in the Asia session.
No, but is that something that tells you, if you're looking for a diversifier at the moment, if you're looking at the tech trade, if you think it's over its skis, if you're worried about the volatility that you're seeing within that space, you come into the European sort of space, you can breathe a sigh of relief, you can sort of sit down, figure out what's going on. Are these assets that represent, therefore, if you are looking for the rotation, if you are looking for some safety, a place maybe to hang out and hide out?
Well, let's call the ref. We can speak to Sophie Wynne, who is Portfolio Manager and Dynamic Asset Allocation Strategist at BNP Paribas Asset Management. Welcome back.
Hello.
Before you sat down, you said it was going to be a quiet summer, which I feel is very confident. Talking of the tech trade, we've had all of this geopolitical uncertainty reignited this week. Some people thinking tech's where I want to be when you have that, because, you know, this is the thing that grows regardless. Do you agree with that? I mean, do you just bat away the geopolitics, look through it and think the two sides have got to come to a logical conclusion because we've got the midterms later and it hurts everyone?
I think I agree with you medium term, as in we're still in this phase where we're in this physical AI stage. There's going to be this build out of data centers, need for power and so on. But in the short term, given the high level of volatility on this high momentum trade, which is the AI trade, how do you go on vacation? So you need to manage
on holiday next week, don't say that.
You need to monitor your factor exposure and duration exposure, as you mentioned with Middle East, but also potential ripple effect from higher JGB yields. So I think that means what we've seen so far has been this technical rotation where there's been this factor neutralization because we're going on vacation. But at the same time, I think where are you going to find some safe haven? And if you think about like the Venn diagram of factor exposure where it's more short momentum, a bit less exposed, and also less duration exposed, I think Europe makes sense in some of the laggard sector where earnings momentum have been more disappointing versus the AI-related stocks. But I think the big, like where you should put your money at this point is China.
Oh, okay. Where in China?
China internet names have rebounded, and if you look at some of the names, the fact that we got all this announcement about data centers investment, so compared to the US peers, it's nothing. As in, like this year, they have been investing 600 billion renminbi compared to 700 billion on the US side. But it's clear that they're stepping up. They have an independent supply chain. They are making an effort to become much more independent on the semi side as well. I think that's where you want to hide as we wait for this factor rotation to finish.
It's interesting. Our big take today is about CXMT.
Yeah, looking for an IPO.
Yeah, and how we don't really know much about it. We haven't really learned much about it as the details have come out through the filings.
Yeah.
And yet this is trying to rival the likes of SK Hynix and Samsung coming out of Korea.
That's an interesting. So how do you invest in China? A lot of Western investors don't know enough about the nuance and the detail to invest there. Can you go single stock? Do you buy baskets? How would you make that move into that market? How specific would you get?
So one way to look at it, so we're still long the China A shares, and they have been lagging peers. and they will benefit from, on top of it, consumer demand recovery, because we're expecting more fiscal, and also the property green shoots that will start to appear. But I think you also have some indices that are just purely China internet names. They are trying to find a way to monetize AI. They're investing in data centers, but at the same time, the drag we've seen in the past due to subsidies that was very negative for the cash flow, it's finally behind us. So we're looking ahead in terms of AI. I think one important point as well is, in a world where Europe is stuck in the middle, we could come in a world where the AI frontier models in the US stay in the US, but China at the same time are just 6 months behind. The models are not by their open source, and it could be a source of opportunities there.
EasyJet's opened up by 14%. We'll come back to that story in just a moment. Is the Chinese, if I make that trade, has the Chinese government got my back? Because it feels like the Chinese government's trying to impose quite a lot of rules around the AI narrative at the moment. Is that going to throttle back the AI story in China? How do I invest around that narrative? They're very keen to make sure that they control the story.
They are investing in terms of the hyperscalers. Internet companies are investing. If you look at the power, it's not a problem for them. So they're going to be much more, I think, resilient in terms of infrastructure build out. They don't have any shortage of materials. They have so much stockpiled and inventories of energy, base metals. So they're much more independent on that. We're not going to hear about shortage stories, delay of plans. They're powering ahead. I think the only point is, yes, the government is behind, but at the same time, it's going to make the path a bit smoother. As in you have government support. Yesterday there was an announcement about utilities companies allowed to invest in data center capacity. I think that's where we're going. So government support in a way is not that bad. But I think I'm thinking about we live in Europe where are the plans?
So you like China, but what about Korea? I mean, we're talking a lot about SK Hynix today, all of the oversubscription. Do you read that as a sign of genuine enthusiasm? Do you buy dips when they arise for the Kospi?
We're buying dips, as in we still believe in the AI story, but I think from a portfolio perspective, it's hard to hold on to markets and also names that are highly volatile. And, you got this exuberance from the leverage ETF. So that's why we're waiting for the vol to come down a bit at this point, and playing this rotation that could or could not be confirmed by, the earnings season. So kind of hiding a bit, but medium term, Korea and Asian equities really make sense.
And would you expect that volatility to be imported to the US with the US listing for SK Hynix?
I think it's a hard thing to say, as in the volatility would only, there's going to be only some contagion if you start to see retail investors disinvesting from Korea and buying the stocks in the US. But from a tax perspective, I don't think it's that attractive. So it means that retail investors, I think, will remain in Korea for now.
Can I assume, therefore, you're not wild about Europe in all of this? A moment ago, you said Europe is the sort of diversifier, but is China a better diversifier? If you were ranking places to hide out, where would Europe sit? Are there better places to hide out than Europe?
I think second after China.
Okay, second after China.
So it's more we're looking for the earnings season. The earnings season, if you look at the non-AI sectors, the earnings momentum has started to come down a bit. You got earnings downgrade since the start of the year. So it's not as if you got high expectation on the laggard sectors such as let's say auto, discretionary, all the sectors. So if the earnings season turned out to be not that bad, I think that's where you could have some safe haven, a place to hide, because they are short momentum. I think positioning is quite bearish on them. So that's how you want to rotate at this point.
Nice to see you. It's going to be hopefully a quiet summer, but an interesting summer.
Hopefully.
Yes. Sophie Wynn. portfolio manager at BNP Paribas Asset Management. Core 6 looks a little bit like this. We're certainly watching the tech trade quite carefully. We'll keep an eye on ASML, but there's other big stocks out there that are on the move. EasyJet is one. Vodafone is another. We'll come to that Etisalat stake in just a moment. But as you can see, broadly, actually, some of the big stocks are weaker this morning. ASML is down by nearly 2%. You've got some of the defence stocks under a little bit of pressure. Even some of the kind of safe haven places like Nestle under a little bit of pressure as well. But there are areas of the market that are flying higher. Sorry. Chloe Melly, over to you.
Good morning, Guy. Indeed, as expected, EasyJet is soaring this morning, up more than 13% after receiving that rival offer from Apollo, which is actually superior to the bid from CastleLake. Earlier this week, it looked like it was set in stone that CastleLake would get its way and buy EasyJet, but we've got now this surprise twist, and we can see that this is leading to a lot of movement in that stock. So we'll be watching out for any further developments there, but we're up, very strongly there. Moving on to another big mover in the UK market, and that is Vodafone, which is up 12% after its biggest shareholder, Emirates Telecom, sold its entire 16% stake in Vodafone at a premium. So we're seeing that really boost the shares this morning here in the UK for Vodafone. Moving on to some steel stocks. So we've got an upgrade from JPMorgan, upgrading Voestalpine, Salzgitter, and also ArcelorMittal, and that is really driving those companies this morning. This is a sector that's really benefiting from the EU imposing those tariffs on steel imports, which is something that is set to kind of safeguard that European steel industry. And so we're up actually very strongly, as we can see here for Salzgitter, up almost 10%. Moving on to Bayer, which is also in the green this morning after selling its minority stake in its contraceptives business to Apollo, which it seems that they are everywhere. We're up about 2% on this, and they said they would take those proceeds and reinvest that in their capital structure. So we're up there on the back of that. And finally, let's end on one downside mover. We've got St. James's Place down this morning more than 5% after a report that one of the biggest advice firms within its network had decided to exit, which is pointing to maybe some retention problems at the company. And so we're down quite a bit there on the back of that this morning for St. James's Place.
Chloe, great stuff. Thank you very much indeed. As you say, Apollo, very busy this morning. You've got the Bayer story that we are watching carefully as well, plus also this offer for EasyJet that has come through. So where are we trading on EasyJet right now? 667. So just think about kind of where the bids are. You've got CastleLake at 690. You've now got Apollo coming through at 715. We're still not at those levels. Why is we've seen a big jump higher this morning, but you do wonder whether or not this is increasingly looking like an offer will be successful by one of these firms. Why aren't we trading at offer price? Kind of what is going to happen next? Are there still, and this is maybe what the market is worried about, issues surrounding whether or not either of these two firms can get around the ownership issue?
Yeah, surely Apollo would need a European partner there.
Yeah, it does. And we don't have details on that, but hopefully we'll learn about that next week. But they are going to need to figure that one out. The CastleLake team had put a couple of Irish guys on the board, and we're hoping that would be enough to maybe get round that. And you do wonder whether this is a kind of short-term story. Do you need to just get the acquisition done and then you can break it up and then you don't need to worry about that kind of ownership thing? You just need to kind of tick the box and make sure you can kind of deliver upon that. But yeah, it's like Apollo's decided that it wants to step in with a higher offer. EasyJet got very depressed in terms of the share price. If you take a look, let me just quickly check where the GP is on this one and when we last traded at these kinds of levels. It's not been for a year. Obviously, we've been dealing with the Gulf War, and obviously that's been a factor. But I think you've got to go back until you've got to go back into 2022, early 22, before it was when it was last trading north of 7.
And you have to wonder if there's going to be a different way that Apollo would run EasyJet. I mean, when we had the takeover potentially from CastleLake, we were reporting that pilots were worried about their job security and who'd be in charge going forward.
Yes. Why are you buying this asset?
Yeah,
are you buying this asset to run it, or are you buying this asset to break it up? The holidays business, you wonder whether there's talk of a lot of people are talking about that being a spin out. That's kind of worth more if you spin it out potentially, but it's been quite successful. So kind of that is one area that you could see certainly that working. But it's got a lot of delivery options coming out of Airbus with the 320 family. Those at the moment those narrow body assets are worth quite a lot. Just having those delivery slots from Airbus is worth quite a lot of money. But you've also got a whole load of quite valuable airline landing slots as well, which potentially... So is this a breakup target? I talked to the Lufthansa CEO a few days ago. I talked to the IAG CEO a few days ago, Air France CEO a few days ago, all telling me, yeah, there's nice assets in here. Like, if they came on the block, we'd be interested. So is this a sum of the parts argument, or is this an operating argument? Do I run it, or do I break it up?
OK, it's going to be interesting to hear from Apollo when the time comes. But for now, EasyJet shares really flying this morning off the back of this news.
That was better than mine.
I didn't actually mean to do it, I promise you. Look, coming up on the programme, the World Cup with a Bloomberg skew. We're going to be discussing the global sporting contest and perhaps who'll win with Carlos Carranza, Senior Emerging Markets Debt Fund Manager at M&G, who's been building a model to tell us exactly that answer. That's next. This is Bloomberg. Welcome back to the opening trade. 19 minutes into today's session. Here's how we're looking. The Stock 600 up 0.2%. Not such an enthusiastic end to the week, really. The DAX up 0.1%. The CAC 40 and the FTSE 100 both up about 0.2%. We are seeing outsized moves from the likes of EasyJet this morning, Guy, up 13% off the back of that Apollo bid. So really, it's more exciting when you look under the hood.
It's always more exciting when you look under the hood. OK, I didn't watch the game last night. I hear Kylian Mbappe had a pretty good night, though. A goal, an assist, France are through. I don't think it's a massive surprise. We were expecting France potentially to go all the way. So they've got a semi-final now, beat Morocco 2-0. The results, surprisingly, maybe not surprisingly, was predicted by the Bond Vigilantes team at M&G, who have developed an economic sport model that has called the correct team to go through in 15 out of the 16 games in the round of 32. If you're wondering who's going to join them next, what does the model predict? Look away now if you don't want to know. Spain, England and Argentina apparently will all make it. That's going to make for a much more relaxing Saturday night for me. Joining us now is one of the minds behind the model, Carlos Carranza, Senior Emerging Markets Debt Fund Manager at M&G. Not a sports prediction model kind of builder in his day job. This is the side hustle. Yeah. Okay, so why does this model work? Because it seems to be, I looked at the data this morning, it seems like you're having a fairly good run. So why is it working?
Yeah, so I would say the following. The model is intended to generate two things. The first one is to connect two things we like, which is, for example, football and macroeconomics or financial markets. So we try to think of a connection between the two, and the model is basically a 50-50 blend, where the 50% is using actual football data, where we look into FIFA's ranking of countries in the World Cup, and the other 50% is where we look at macroeconomics of the country, and based on that we look at GDP growth, population size, inflation dynamics, and very importantly fiscal dynamics, which are a key point of discussion when we look at all these games that are coming ahead of us. And based on that, we create this formula where we predict the score. Yeah. But it's important to keep in mind that the idea is to think of a way in which we can connect football that everyone is talking about, but channel that through an angle of macroeconomics. Because
Lizzy's just waiting. She's so sceptical.
No, because all of these brilliant international players from such an early age go and play elsewhere outside their home country. I'm thinking of Haaland, right? Playing in Manchester. Why would the success of the Norwegian team then be tied to the macroeconomics of Norway?
Yeah, it's a fair question. It's a good question. We've been thinking about that ourselves too. Sometimes it's the law of the large numbers. The larger chances you have to fund sports in the early stage of any country, then the higher the likelihood that you can find stars that will eventually play for that country. And then, of course, there's exceptions. There's Messi, for example, is a player that most of his professional career was in Spain, yet he's playing for Argentina. He was born in Argentina, spent his early years in Argentina. But Argentina did not have, at that time, enough money to fund the treatment that he required in the young years of his life. And he was very, very close to playing for Spain in the World Cup. Eventually, he ended up playing for Argentina, but there was a point where apparently there was some debate. So or which country was he going to play for?
Well, yeah, people always ask Haaland if he would have played for the UK had he stayed for longer, yeah.
Right, exactly. So, but the size of the country sometimes it's less relevant, but the funding towards sports in countries that have been developed for longer, they have a higher likelihood of making a sport a big deal into the country.
Is that why Europe's doing so well?
In part, yeah.
But if it's a numbers game, why isn't the US winning the World Cup year after year after year?
Yeah, it's another question, but I would say the following. The US also, soccer or football,
that's the fundamental problem. They don't understand that you play it with your feet. Like, they call it soccer. Like, it's football.
Well, the president thinks if you call teacher, you could win.
But it's true that the US has a variety of sports. It has basketball, it has so many other sports where young kids play. Yeah. It's not just football alone. Other countries have, Argentina has the majority of the kids play football, right? So then that what happens when you get cases like Maradona or Messi, right? Whereas in the US, I think they have resources to invest in sports and they have a large population, but they have so many other sports which are more mainstream to their day by day.
So basically, if England win, Keir Starmer can take the credit for it as his final act.
On the economic stability model. Yeah. But you would have thought China, so in theory, China should do very well, but doesn't. You would have thought India do very well, but doesn't. Like, India plays cricket. That's not kind of where they focus their attention.
Exactly. It has to be the main sport that they care about, the main sport that they're passionate about.
Are you surprised how well the model has done in terms of predicting the outcomes?
Well, I mean, in part, there's two things to that, right? I believe the model has had great traction in terms of generating synergies, in terms of discussing stuff, in terms of thinking, how do we think of the macroeconomics of this country versus the macroeconomics of the other country, especially with what's going on today with fiscal dynamics being so important for the world in terms of investing. Now, as for the score of the model, I'm not that surprised because also in football, there's always this randomness component. Yeah. For example, if a team goes to penalties, some statistics say that it's almost equal to flipping a coin. So you put the best team in the world, the team number 1 ranked by the FIFA, and a team number 10 ranked by the FIFA, and they go to penalties. Yeah. And it's almost equal in terms of who can score, because players get super stressed. Messi has missed so many penalties.
Emotion comes into it,
Yeah.
So, who's going to win?
Well, the model predicts only one game per time, so we don't put the full stream. But let me tell you one interesting scenario that we have analyzed. Argentina is one of the top 3 in the FIFA. It has Messi. And France is definitely a very, very strong, probably the best candidate by far. We've seen an excellent performance in every single game. If you put them together in the final, you will have a football clash, obviously, but you will also have a fiscal clash, because Argentina is the country, one of the countries in the world that delivered the best fiscal adjustment almost in the entire world over the past 2 years. And France has a 5% fiscal deficit. Still very large, debt to GDP at 120%. So fiscal clash, football clash. Very interesting.
Carlos, it's going to be a big weekend for you and for us. Carlos Carranza there, Senior Emerging Markets Debt Fund Manager at M&G. Well, coming up, SpaceX has shown the might of American space and technology with its record-breaking IPO. That's next on Bloomberg Tech Europe. This is Bloomberg.